Well, the Westpac Consumer Sentiment Index fell another 3% in August. It's now down at a level of 81.2, and that's comparable with the lows during the global financial crisis and COVID, but it's still well above the lows that we saw in the early 90s recession. It's now fallen 23% since its recent peak in November last year, and when we look at the various components of the index, the ones that have been the weakest have been the 12-month outlook for the economy. It's the most volatile component in the index, and that's not surprising. It's down 31% compared to 23% for the overall index. And the other component is now a good time to buy a major household item, and that's now down 27%. That's more of a worry, and I think it's very much reflecting what I think is the main factor behind the weakness in confidence, which is inflation. So when we look at some major household items such as furniture prices are up by 7% in the June quarter and 8.3% over the year. Major household appliances prices are up by 5.3% over the year. So we're really starting to see the impact of inflation on various components of the index, and particularly on the consumer durable area. There's also concerns about higher interest rates. So we saw an 8.9% fall in the confidence of those folks with a mortgage, and that compared with only a 2% fall with those people that own their house outright, or indeed a flat result for people who are tenants. And the outlook for interest rates still remains quite daunting. So last month, 73% of respondents, after they'd seen the rate hike in July, were expecting rates to go up by at least another 1%. We saw another 0.5% rise in August, and after they'd seen that 0.5%, still 53% expect the rates to go up by at least another 1%. That's certainly in line with our thinking. We're expecting that from August that we will see another 1.5% total rise, with 50 basis points in September, and then a series of 25 basis points till the end of the year, and one last hike in February. The good news, of course, was around the labour market. So people are still really confident about job security. So we saw a 5.8% improvement in how they see the labour market, and the level of confidence in the labour market is now near record highs. And that, of course, is one of the main reasons why, despite the overall weakness in confidence, strong household balance sheets, they've saved around $250 billion more than normal because of the money that was paid during COVID. And the strong labour market means that at the moment consumer spending is holding up pretty well. But I think as we go through the rest of this year, we're going to start to see consumer spending slowing down. Unsurprisingly, the really weak part of the survey was around the housing market. So the decision on whether now is a good time to buy a house fell by 2.3%. That index is 41% below its peak back in November 2020. And it's basically been fairly stable since March this year, because there are two big factors that drive that index. Firstly, affordability, and secondly, how people feel about the housing market in general. So when it started to appear that house prices were peaking around March this year, that index bottomed out. As people were expecting to see house prices easing, that improves affordability. But the general confidence in the housing market is still quite negative. And that's why I think this index is now a good time to buy a dwelling, will remain around these lows for some time. But where the message is unambiguously clear is the outlook for house prices. So we saw a 7.5% fall in our house price index, and it's now fallen below that 100 level. That means that we now have more people expecting house prices to fall than rise. Now in New South Wales and Victoria, that's been the case for some time. And indeed, we saw a stunning result in Victoria where the index fell by more than 17% to a level of a little over 80. Those levels of around 80s and that can be achieved in terms of the outlook for house prices, as we've seen in previous cycles. So I think it's likely that we'll see further falls. And even the really strong market, which was Queensland, its confidence was down by 10%, and now it's only slightly above that 100 level. So clearly the unravelling of the housing market has some further way to go. Westpac's forecast is that from the middle of this year to the end of this year, nationally house prices will be down by 6%, and next year another 10%. So we have further falls to go in house prices. Well, the Reserve Bank Board meets again on the 6th of September, and we expect that they will raise rates by another 50 basis points. That is because the current rate at 1.85%, while it's moved very quickly from the 0.1 we saw before the May meeting, it's still well below where the Reserve Bank sees the neutral rate. They see that at around 2.5%, so I think it would make sense to move quickly towards that neutral rate, 50 basis points in September, and then to back off and slow the pace down to 25 basis point movements thereafter for the next 4 months to get the rate up to 3.35%. We're expecting that growth next year in the economy will slow to around 1%. That's from the 4% that we're expecting this year. And that is going to be necessary to put a lid on inflation pressures. The way I look at the inflation story is that we had the first stage of inflation when we had the shocks around COVID and the big collision of this boost of strong demand with constrained supply. We then saw the second wave, which was associated with the war in the Ukraine, where we saw a huge lift in energy prices and food prices. We've started to see some easing on both of those, but now what I think we're seeing is evidence that prices are rising in Australia, particularly with decisions that are being made by business. Business is now detecting that there's an air of inflation thinking around. And when business sees that, they take the opportunity to increase their prices. And that's for very good reason, because their costs have been absolutely lifted significantly and their margins have been affected. So what the central bank needs to send out as a signal is that next year demand is going to be very weak and the capacity to continue to raise prices will be very limited. If we can get that message out there, then we'll see that inflation next year can come back down to around about that target level by the end of the year. But if that message isn't there, if the Reserve Bank backs off with their rate hikes, demand remains high, then in the short run that might give us some relief. But in the long run it runs the risk of inflation returning, and even bigger rate hikes will be required during 2023. We don't want to see that happen. Thank you.